So this is the third and the final addition to the new series of videos, and this is the fun one to me. The first two were quite boring. This is probably going to be targeted to the majority. Even if you're profitable, I'd still say watch this video. It's very useful. This has been my focus for the absolute last year, actually. But yeah, let's get into it. So what traders past the intermediate stage should focus on. So past the intermediate stage means you got the technical analysis done, trade plans are pretty much being made, and yeah, you're just done with the learning curve essentially. So what this video is going to focus on is trade plan building, process building, practice, avoiding over confirmations. I know we just touched on it on the last video, but it's very, very important, right? Stats, what are sustainable stats and the importance of them, specific stats to focus on, focusing on performance and how to increase performance and immediate feedback, focusing on trade management and time frame variance consideration. So there's going to be quite a lot to talk about here. You might want to have a snack or like a drink or something. Probably going to be like half an hour in this video, I'm assuming. So building trade plans, processes, and practice, right? So when you have confidence in your technical analysis, the next step, well, the next and the most absolutely necessary step, is to build a trade plan around them. This is where most traders start to neglect the idea of a trade plan and trade plan building, and they just slow down in progression. Like it's what I said in the previous video. Imagine you have a graph, right, x and y axis, right, and it's like an S, right? So you're going up, up, and then you start to level off, level off, level off. And that's because it's very easy to learn, but you see the things you need to do on your own back, like the practice and building a plan. These are the things that nobody likes to do. They don't like to do it. They think I don't need to do. I just need to go and trade. You don't. Um, you can't beat preparedness. Someone that's prepared v someone that's unprepared. The prepared guy is gonna probably outperform. I'd say probably even 10 out of 10 times. If it's 9 out of 10, the 1 out of 10 times is an absolute fluke. Your trade plan should be streamlined and simple. Your focus in trading is always to build simplicity around processes and plans, right? It makes it easier to follow. Uh, the trade plan should preferably be a top-down approach, gaining a bias, confirmations, and entering trade. Again, from the last video, direction, confirmations, and an entry. Uh, your first plan doesn't mean it's your last plan. You know, it's like a prototype. You'll get it. You'll see. Does it make sense? Can it be better? Do I like it? You'll practice it and see. Maybe it's not what I like. Take things out, add things in. It's the dog's work. This is like, and it's an endless refinement, by the way. Like even now, even me right now, like I'm trying to focus on. Is there like a better confirmation? A better confirmation where I get more bang for buck, where it's not gonna really. I can take a confirmation out that's gonna not lower my frequency and keep my win rate the same. Okay, that's less tick boxes, and I'm gonna get faster trades. Like you see, it's kind of like an endless process type thing, right? Consider building processes in grading high vs low probability days. Think of processes as like checklists, right? So, for example, is a daily candle in a state of predictability? Is there high impact news tomorrow? This is probably a day you can expect to see a setup, right? If it's a predictable day and you got some sort of impact news like orange, red, yeah, you can probably find, uh, probably most likely you'll find a trade setup during that day, right? That's a probability day that you want to go. If it's a bank holiday and the daily candle is very wicky, and you can from the daily kind of like I can be long or short, that grade that as a low probability day, right? So the checklist is a predictable daily candle print, is a high impact news event. Tick tick. Okay, I'll probably see a setup tomorrow. That's a process to grade if it's a trading day or not. People should have these things, right? And of course, that's also a checklist for uh, if it's not a high probability day, because if you don't tick the check, if it doesn't tick both, probably not. If it doesn't tick any, absolutely not. If it ticks one, where if it's is there a state of predictability but there's no high impact news, it's like a lowered expectation type of day. That's why I call it. Build processes for determining if it's a trading day, which you will then use your plan, right? Which is, I said, the direction, confirmation, entry to execute. Right. Further processes can be when to shave stop losses during a trade. We'll touch on that later in the trade management slide. When you have built a plan and a few processes to aid your trading, like grading the probability day, staying out, whatnot. When to cut a trade could be another process. When you're doing a trade, is it doing X, Y, Z? Okay, cut the trade. The next step is just to practice, right? This is the part everybody skips, right? I'm telling you, do the practice. You will only gain confidence in practicing. Nothing else is going to lift your confidence. Experience is the only thing that's going to lift your confidence. Um, and you'll also see if things need to be tweaked or reconsidered inside of your plan. You might have a plan you think is good until you test it, you think it's not that great. Like on paper, a lot of things look good. Like the plan with five confirmations, it looks so. Oh yeah, you got a market share shift in there, displacement. Oh my god, and a second leg. Damn, like yeah, you're going crazy. It doesn't matter. It's not practical. It's not practical at all. You'll probably see when it comes to real time, all those tick boxes, they're not getting met. That's what I mean. Practicality and the reality, they're two different things. Look, take the advice from me. We have 25 million plus in funding this year, and I am literally saying it's off the back off of practice of a good trade plan. I'm telling you, just do the practice with a good trade plan. Of course, it's all full circle. You need everything. The good technicals make a good plan, good practice, good results. Assuming you have the technicals down and they're good and they're reliable and you make a good trade plan, just practice, right? Avoiding over confirmations. So confirmations in trade plans are necessary and they're also personal to the trader. Someone's confirmation may not be convincing to you, but it may be convincing to them, and vice versa. Like a, a crossover, an EMA crossover to me doesn't mean anything. To someone, it might be like a thing where they're going pushing all their poker chips to the table. Now that's the best confirmation I can get. The level of confirmation needed can also vary trader to trader. However, it can be argued that there can be a case of too many confirmations, right? If a plan consists of too many confirmations, then the likelihood of the trader finding a trade reduces, as there's more steps, confirmations to reach an entry. Therefore, too many confirmations are not good. Think of a sniper, right? A sniper needs to call his leader, shall I take the shot? The leader says, okay, wait, let me call my leader to see if you can take the shot. Then that leader says, let me call my leader to see if I can take the shot. Look, if you have to do that 5 times, do you think that that target that the sniper was going to shoot is going to still be standstill for a shot? No. You need only a necessary amount of confirmations, and I touched on this in the previous video, right? When there's a marginal decreases to your win rate, uh, then you don't want to add any confirmation. You want to look to actually lean it out and reduce the confirmation. So, for example, displacement and a shift in market structure can be the only two confirmations you need. Now, there might be times in price where not every single day trade is the same, right? They're similar, but some days where you're not as convinced, you need like an extra layer of confirmation. It's a bit choppy, not as clean the swings that you want. Maybe then you might need another layer of confirmation. So you have two go-to confirmations and a third one for backup if you need an extra like layer of confirmation. Like, for example, if you're trading a market maker model, you have a market structure shift for displacement. Let the first leg go, and the second leg, when the first leg goes, and you see, yeah, okay, it's market maker model. That's the third confirmation. The second leg is the entry. You see my point? So that's something necessary, right? Anything after that, I think, is absolutely unnecessary. I think anything past 3 confirmations, whew, I don't think you're seeing a trade in like 6 months, if ever, right? An example of this is what I just said. Someone that needs a shift in structure be someone who who needs that and say specific handlebar formation and indicator confirmation, right? The guy that just needs a shift in structure, one confirmation, he's gonna find way more trade setups than the guy that needs the two others following it. Um, Now remember as well, right? Confirmations, it sounds like a synonym to like winning more. It doesn't, right? You can have 5 confirmations and still lose a trade that just had one confirmation. Uh, it doesn't really mean too much, right? Now, relating back to the previous slide of practice, this is where practice is important, right? As if frequency is low, perhaps you need to reduce your confirmation. So now you see you have your trade plan and you're saying, okay, you know what, I'm getting one trade a month. Like, I need to change something. Well, it's probably your confirmations. It's either your read on price is not as good as you thought it is, and there's moves, right? There's a difference, right? If your frequency is low, it's one of two things. Either there's too many confirmations or you just think your reading price is good, but it's not. Where there's moves happening, you're just not seeing them, right? If you show someone that's well, better versed in price, reading price, they'll be showing you, but there's a setup here, man. Like here, you could have looked for a setup here. There was a setup in this area. You could have hunted here. It could just be like a skill gap. But if it's a thing where it's confirmations, like you're really sure your reading price is good and it's confirmations, recheck your confirmations and maybe remove one. Which one do you remove? That's there's a hierarchy of them. So see which one you place the least importance, or if you just have the time to test, uh, mix it up, keep two confirmations, leave the other, then mix and match them and see you know which mix of them have the better stats. Talking about stats, this slide is going to cover the stats and the importance of them. So once everything is said and done, right, that being the learning curve and making the trade plans, right, the rest is focused on gaining stats to measure your performance. This is the end all be all. This is what it all boils down to: retail, ICT, SMC, Wyckoff, fundamentalist, whatever. It's all about the numbers, right? In the end, it's just numbers, right? The main set of stats to focus on, right, is the win rate and the average risk to reward. These are the main factors of performance you would take into consideration as a trader. There's a few more, but for now, you and forever, you can just get away with focusing on your win rate and your average risk to reward. The following question is usually then, what is a good set of stats for the win rate and what's a good set of stats for the risk to reward? The risk to reward is the more black and white metric here. What I mean by the more black and white metric here is this is the one that shouldn't really change too much. It's never going to be a fixed number. It's more like a ballpark figure, right? I'm saying the risk to reward should be around a 2R, right? Anything higher on average is great. If you're like in the 2.5 ballpark figure, great. 3R is phenomenal, right? If you get 3R on average with a semi-decent win rate, phenomenal. It's highly unlikely though. If you can do that in the world of like, if you have a Sharpe ratio of 3 in the investment world, you're like, you're up there, right? This is what I'm saying, why social media usually is full of nonsense, because everyone's a average 10R trader with 50% win rate. Uh, you see, it's not realistic, right? The win rate preferably around 50%, right? Anything higher is great, but 50% is a minimum. You want to be at least on average around a minimum. Now, the thing with win rate, yeah, is it can fluctuate. So the R should try and be maintained as much as possible here, because of course the risk to reward is that black and white. It shouldn't really change. You can always go for the same risk reward of the trade, right? However, the win rate can fluctuate as trading performance has highs and lows, right? Trading performance, look, you're the trader entering, exiting the trade, they can have times where they're just not on the ball. We're not mechanical traders. There's only two types of traders: quants and mechanical and discretionary. We're not quants. We don't have bots trading for us. We're not quants. No matter these guys on Twitter and whatnot, they want to say that they're as mechanical as possible. They're not quant. You're a discretionary trader. You might have somewhat of a mechanical aspect to your plan, like a checklist, but you're not a quant, right? Therefore, it comes down to the trader's discretion, and humans have highs and lows in performance. Athletes have the same highs and lows in performance. It's normal. That's why your 1 month you can have a great win rate. You can even be 100% for a month. The next month is like 25% win rate. So you see over a large sample size, considering your high performance, low performance, whatnot, um, it will average out. That's the average of the win rate you're trying to find. That's why I say when you practice, do like a sample size of at least 30. 50 is better. Then you get more of an understanding of your actual win rate and your average risk to reward, right? It is unlikely that you will out win rate a very low R that is less than one. It's like, you hear people in the fitness industry, you can't out train a very bad diet. It's very unlikely you out win rate a very low R, like less than one. So like if you're getting 0.5 R in general, you're not gonna out win rate that, because one loss is gonna make two, it's gonna get rid of two wins, and just a bit of a losing streak, like you lose three, yeah, you're finished. You're gonna find it hard to come back from that. And the rate at that you're winning these is, think of like a bath and the tap's running, right? The tap, right? It's like you're trying to win, but it's leaking faster than the tap is running, right? you're not gonna outfill that leaking bath. It's leaking at a faster rate than the water's pouring in. It's like you can't out. Your wins are just not gonna hold you up at the rate you're gonna lose, right? You can lose 50% of the time. You can win 50% of the time, and you're still gonna lose at at a faster rate. Do you see my point? If your risk reward is negative, just remember that it's very unlikely you will out win rate a very low R, right? The win rate comes down more to the trader's ability of execution than the plan itself, right? Hence, why two people execute the same plan have differing results. Do not believe this idea of fully mechanical plans you hear online. Like I just said, you're either a quant or discretionary trader, and we are not quant traders, right? Remember, it comes down to our discretion, our execution. We can have days where we're off, you're sick, you don't feel in the you're not in the mood. Yeah, there's something like a tilt going on, you're trading in a drawdown. These things can impact win rate, right? You might just it's win rate is the more lenient stat, but that's why you have to keep your risk to reward as fixed as possible. Try and go for those 1.8 to 2R trades, because it's going to make up for those bad spills of win rate being low, right? Don't also fall into the idea that your R has to be super high. This sounds really appealing to the new people. When you hear the 10R traders, I can lose 9 and then win 1 and I'm back. Your account is destroyed after 9 losses though. However, an average risk to reward of say 5 is very unlikely as a day trader. And let's just put into context, right? Say that the average daily range is around 80 pips, which it is around 8 pips for like Euro USD, right? And the stop loss is 10 pips. This means on average, you're getting 50 to 80 pips of the range, not even considering the 10 pip stop loss. So there's only really 70 pips left. You're getting 50 to 70 pips, and that's considering that you're 10 pips away from the opposite end of the range, which is very unlikely. You're getting 50 out of 70 pips of the range, which is so unrealistic on a consistent basis, right? I say keep a 1.8 to 2R minimum, right? And you'll be all right, right? If trade subs offer more, of course take them. It can vary on a trade by trade basis, hence the word average. There's some trades where you'll see my episodes, they're 1.7R, 1.5R sometimes. 1.5R I say is the absolute minimum. It's like desperation type thing. 2R, some even over 2R, 3R, great trade. But yeah, remember, you're not gonna. It's very unlikely you're gonna out win rate a very low R. So try and keep that that R fixed as much as possible, around 1.8 to 2R. And remember, going for 5, anything above 3, unlikely on a consistent basis, right? And you care about the consistent basis, not anomalies. We do not consider anomalies inside of stats, right? So focusing on performance and increasing performance. Now, from the previous slide, we established that the focus is on the win rate and the average risk to reward. It's likely that at first your stats may not be great and that you're struggling to find a footing with getting the stats up. This is where you need to be critical inside of your own journal and tracking what's going wrong in your trades. Look, people don't journal, they don't even keep track of their trades. What can you do? How do you know what's going wrong, right? Sometimes it's also just a result of a poor plan, and maybe your technical analysis is just not as good as you thought it is, right? Like I said before, uh, everyone thinks that they're probably a bit better than what they are, and until you practice, you don't really know how good you are, right? Increasing performance is done by trying to either improve the win rate, the risk reward, or of course, in both cases, both of them. So let's first discuss the side of the win rate. In terms of win rate, it's hard to talk about trade plans as some people will not share the same concepts as me, but as not everybody's an ICT concept trader like myself, of course. But I would highly recommend that you trade in line with some sort of daily or 4-hour direction, right? Having a bias makes finding setups a lot easier to find. Also, have an effective set of confirmations. So let's touch on that. If you're look here, I say this. I'm very big on a bias. If you're on my free channel, which where there's upload, you always say bias, bias, bias. Next daily candle higher, next daily candle lower. If you don't know this, it's better to stay out. The reason is this: if you know where the daily candle's going, you know where the 15 minutes going. Simple. On a bullish day, what am I waiting for? I'm waiting for a run lower and then a run higher, a retracement to go higher again. If I don't have the bias, if I don't know where the day is going, am I going high? Am I going lower? I'm one impulse trade away from losing, right? And you know, you don't feel too comfortable taking trades where you don't have a high time frame bias. It's a bit of murky water. I see it coming, but I don't know if it's going to go higher because look, on your 5 minute time frame, you'll see setups going both ways, but one way is always going to be a lot shorter lived. We won't even offer you like 1R. On the other side, will give you the majority of the day's expansion. You want to be in line with the day's expansion. You'll win more. Also, if you're trading in line with the expansion, the daily expansion, right? Um, say no, let's say you thought the day is going to go higher, but it ends up going lower against you. You probably won't find a trade setup then because you're only priming yourself to find bullish setups, right? And if you're just seeing nothing bullish and it's just bearish price after bearish price, that's a day where you sidelined, you didn't get in, but no damage was done. Now, no damage done means, there's not a loss to knock the stat of your win rate, right? Um, Another thing is the set of confirmation. So I always recommend to always wait for some sort of lower time frame displacement to begin hunting your trade setups. Displacement was like an energetic move. To me, like after running stops and an energetic move away, yeah, you're probably gonna trade in that direction. So that's my cue to start trying to align myself. Sorry. Another tip is to consider if your trade setups visually look the same on average. This shows that you're following your trade plan. Now, if your trade plan is effective, and you're following it, the same confirmations and entries, they always look quite similar. Look, if your confirmations are running into a high time frame level, displacement and the market structure shift away, your trades are going to look very similar on average because it's all going to have those key components. Those key components is gonna. It's like making food with the same ingredients. It's gonna taste the same on average, right? Um, Having the set of effective confirmations is gonna probably bump up your win rate. If you're just trading with no confirmation, like just touch level, some people just trade into like a high time frame level and enter no confirmation. That level might just get blasted through. That's where your confirmations come and save you. The final tip is to practice patience. Not every day is high probability. People usually take a good setup followed by three poor ones as they rushed back into the market. Look, you see, you see, it's this thing. People want frequency. Uh, you know what recover frequency is here as well. So for risk to reward, it's two factors, right? There's two factors to consider how to increase your risk to reward, right? It's efficiency in your stop loss placement or aiming for more profit. Study how much drawdown you usually take in a trade. If you don't really take a lot of drawdown, can your stop loss be a little tighter on average, right? If you study your wins, like where was your stop loss and where was the next level of invalidation? Did price really reach there? On average, does price get there usually? Are you good at your entries? You could probably tighten the stop loss a little bit, and you'll get more risk to reward because the stop size decreases, right? Study the winners and see if price, more times than not runs past your take profit. You maybe can add on an extra 5 pips. You know, that's gonna increase your risk to reward. Uh, Aim for maybe 0.25 more R on average. If so, whenever you look to increase your stats, do it marginally. Marginally means do it like in increments, small, like small increments. Being told to increase your R doesn't mean to automatically double it. Look, I told a guy one time. So I do a lot of stats checking for my mentorship. Um, we have a set of stats that I try to get them to get, and one guy I told him you need to get a bit more R. He's like, all right, cool, I'm gonna work on it. He tries to come back to me saying, bro, it's impossible to find 3R. I thought 3R, where are you talking about 3R, bro? I'm talking, look, you're at 1.4, try to get to 1.8. Try to get 1.8. Why are you trying to nearly like double it? You don't need to double the numbers. Incrementally increase it. Even 0.2R on average more, over 10 trades, 2R more, it's not bad, right? It's not bad. That's like an extra 2, 3 trades at 1R. Now, another thing to focus on is frequency. Now, from a pure statistical standpoint, win rate and frequency have no correlation, right? For example, if you have a six-sided dice and you roll it and you keep rolling it, does the chances of each roll, right, is the same chance of landing any number? It's 1 out of 6. It's not going to increase the chances of you landing a different number. It's the same with your trading, right? The frequency has no correlation to your win rate. A losing trader should not look to increase frequency. They'll only lose at a faster rate. Most people trade too much. Reducing your trade frequency with high quality shots is probably better. Is probably the better approach for most. Now, of course, this is from a pure stat speaking. This is like ceteris paribus. There's no other um, considerations essentially, right? Of course, now talking as humans with a high frequency, there's probably a burnout that comes with every single trade taken, right? So if you're a very high frequency, like 3 trades a day, it's probably that third trade is probably like the crappiest quality trade. From the first one to the third one, there's definitely some sort of big decrease in terms of the confirmations or the quality and effort of the trade. So perhaps I think most people what would they benefit from is bump down the frequency. They can. It's all good. I do believe there is a small like relationship between frequency and win rate, but it's nothing to do with like the plan. It's to do with the person executing the plan because more emotion is like to come into the trader. You know, like if you take 2 losses and you rush back in, usually over trading, over leveraging happens. That's the small thing. But if you're talking like a robot is hitting the same trade plan over and over again, the frequency doesn't mean that they're gonna win more. You'll just get your set of stats at a faster rate. You see my point? Um, yeah, so remember, there's really no relationship, there's no reason to increase your frequency if you're a losing trader. The only time you'll look to increase your frequency is when you're winning. And when you want to increase your frequency, if you're a day trader and you're working off of 4 hour levels, right? And then you say, yeah, to increase my frequency, I'm going to use 1 hour levels, and I'm going to use my entry time frame from 15 minutes to 1 minute. That's a whole different plan. You know, you're not going to get the same set of stats. It's like this. It's like playing football. You know how to play on the right side. You don't know how to play on the left side. You know how to play as a defender. You don't know how to play as an attacker. That's a whole different trade plan, my friend. You don't know what the stats are going to be like. It's a whole different ball game when you stop working from 4 hour levels and you go to 1 hour levels and 1 minute time frame entries. They say, oh, but it's fractal. Try it and you'll see. You'll come to the same conclusion. I've been there, done that. When you have a set of profitable stats, as mentioned before, and you're absolutely confident in your ability to trade, then look to marginally increase your frequency. Remember, not if you're losing, if you're profitable, right? Now, this can be done by maybe adding another pair to the watch list or to scan through a few markets for you to consider trading the next week. This is where frequency can help you as you'll build the account at a faster rate as your plan and you as a trader are profitable. Notice how I didn't say lower the time frames. Look, lowering the time frames is not a good way, in my opinion, to find more setups. Even like funds and whatnot, uh, their plan buy and hold, they don't do that. All they do is they look to different markets, overbought, oversold markets. If something is clearly underbought and it's at a good discount, they'll buy it. They don't go and say, you know what, yes, we're working off the weekly time, like long-term trends, let's work on short. They won't do that, right? Um, you don't change your whole plan to get more frequency. What you do is you try to you apply the plan to more markets, right? So for example, EU, GU, DXY. Let's say you want to increase your frequency. On the weekend, maybe scan through some cross pairs, right? Like Euro AUD, JPY pairs, whatever it is, right? And find a pair where you think is predictable in the weekly or daily time frame where you should expect, yeah, this week should go lower. I'm going to try and be short on this pair for this week. You can probably increase and find at least another trade setup through the week. And just like I said before, when you increase your frequency, marginally increase it. You don't need to double, triple it. Maybe one more trade a week or one more trade every 10 days or something like this, right? You don't need to find double your trade frequency. Uh, if anything, I want to give you this perspective. Trade increasing your trade frequency or aiming for one more R on average on your trade. Which one's better? I had this conversation with someone that I know, right? He's a lot older than me. He does very great for himself. I speak to him. He's a very wise person. And he said, if you just get on average one more R on your trades, that actually replaces you trying to find a one-to-one trade setup. You have to do less work. And he's like, you're already in the trade. If it's really going your way, try and milk it for as much as you can. It actually makes up for the loss in frequency, which is true, right? But of course, there's pros and cons. Like, does every single trade run like how he's mentioning? It's probably a select few that run, these things. But I say rule of thumb, right? If you're looking to increase your frequency, apply the same plan to just more markets. For example, maybe look at the indices as well. Focusing on immediate feedback. So as you journal your trades and perhaps through your practice, you'll pick up on things that you were able to attach losing to like immediately. So for example, I know someone who they just can't win on Monday. His stats for the Monday are mainly losers. it's better for him to throw the Monday away. It's immediate feedback, right? You don't know why it is. There's no point of even you looking into why. If categorically you're just getting, you know, dealt with on the Monday by the market, just throw it away. Just take the immediate feedback. Don't try and wrestle with it. So don't say this is the day I'm gonna beat the Monday. No, just throw it away, right? It is usually the case that you perform better in certain weeks of the month. It is rare for your P&L to be consistent through each week. The economic calendar for the month usually doesn't even favor the first week because it's NFP, right? Some days are just not as favorable as every other day. Understand where you win the most is a benefit, right? It's like your edge, as you can focus your energy into these areas and reduce exposure in periods where you likely lose. For example, I think most people Wednesday, Thursday, Friday will perform better than Monday and Tuesday because, and I say this in my free channel often, the the weekly candle's direction it only gets more predictable towards the close, right? Because as you get closer to the close of a candle, you can see where it's going to close. From the start, it just opens, you don't really know. By Wednesday, Thursday, Friday, it's probably a lot more clear on where the week is likely to go, and you can align yourself with the weekly bias, weekly expansion. The days should be trading in line with the week. Easy 4 hour candles to work in. You'll probably do better in there, right? Most cases, I assume people probably get chopped up in the Monday. There's also the factor that they're just trying to jump into the market immediately. The week's open. Let me just try and make back what I lost on the last week. There's a few things. If you see where you're clearly performing better like categorically, I perform better here. Focus your energy there. I don't perform good here. Take your energy away from there and put it into where you perform good. This little these efficiency gains is gonna really it's gonna really make it boring for you. But for your stats, it's gonna do everything good for it. And remember, it's about the stats and not your feelings, right? Any trends you pick up, whether good or bad for your system, just take it the immediate feedback, like I said, and make an iteration of your plan. So if you don't know what an iteration is, it's probably better to Google it. But an iteration is basically you have one thing, and then the iteration is basically a copy of it. It's probably a copy of it that's just a better version, right? Or like a newer, like a lean version. So for example, like I said, you have your direction confirmation entry plan, and now you see, okay, I don't really perform on Monday, and I perform better end of the week. You can add in don't really consider Monday and have higher expectations for Wednesday, Thursday, Friday of the week. That's an iteration of the plan that you can make. Um, your chart time should also really only be when you're looking to engage the market on a specific day. Otherwise, you shouldn't be at a trade desk. So when you think about it, every single minute we spend on a chart that we're not really getting into or like hunting a trade setup, it's a waste of time. It's a waste of efficiency. The shop's open and then there's no customers. You see my point? When do you want to have, when what's efficient inside of a shop? When you have customers pick something up, come into the shop, they pick something up, and maybe they pick something up and they just walk out the shop. That's like missing a trade. You see my point? But you want to really prepare yourself where price is about to offer your trade setup. Like, the customers pick something up and they're about to come to the checkout and check out. That's when you want to, that's the efficiency of a shop. If the shop really only experiences that around, let's say 5 to 8 p.m. and the rest of the day is absolutely dead, they should really open 5 to 8 p.m. That's like you as a trader. Uh, on days where it's probably low probability, remember what I said, you want to have processes to grade your probability days. Don't even bother because you're probably going to take a loss and it's just a waste of your time, right? Start being efficient. If you're only at your trade desk for when it's go time, you're doing it right. It's easier said than done because there is an argument for addiction to trading as well. So risk per trade based off your stats and your system. So we're made to believe that we should always risk 1% of our account. However, the risk per trade revolves around a few metrics: a win rate, risk reward, and frequency. If I take one trade a week at 2% risk, is that poor risk? Risk per trade is by a system to system basis, right? It's not a one size fits all. As a swing trader, risking 5% a month is by no means over risking. If I'm a swing trader and I take one position, 5%, how much percent would a day trader give themselves on a day-to-day basis? 1%. How many days are there? Trading days are there in a month? 20%. So I'm actually risking a quarter of the day trader in one trade just because there's one trade at 5%, but I've capped my frequency at that one trade a month. I can only lose 5%. Is that poor risk? No. It's just we're made to believe it is, but it's really not poor risk in my opinion, right? Capping frequency is important as it limits the risk. And I said this in my second podcast with Riz, if you want to rewatch that. I said if you take 5 trades a month at 1% per trade and a risk to reward of a 2 minimum, then you're automatically capping your loss at 5% if all 5 lose, right? And profit is upwards of 10% because our minimum of 2, it could be 10% plus. The real work is in manipulating these numbers like how I'm explaining. Risk per trade, frequency, win rate, average risk reward. When you have a good read of these for yourself, the fun starts. It's like, that boring phase you go through where it's like, making a plan, whatnot. Once you got these again, it's like a breath of fresh air. It's all fun again, like for a while, right? Because you can make another approach now and you can play around with the risk numbers and make it suit yourself. So the key in this is capping the frequency. If you don't cap the frequency, because capping the frequency caps the loss. It doesn't necessarily cap the profit, it caps the loss. That's what people don't understand. So now, if you're day trading still, you can still give yourself a 2% risk per trade. Perhaps you just got to cap yourself to 1 or 2 trades a week. Because if you cap yourself, let's say 1% risk a day, and you're trading every single day, that's 5% risk a week. The person that's risking 2 trades at 2% a week and they're capping it at 2, and doesn't mean they shoot 2 every single week. They might just find 1 trade up or none. They actually have a better read of their risk management than the person that's just blindly risking 1% a trade. You see my point? Also, as well, if you're someone with a higher frequency and you take more trades, probably lower your risk. Because, of course, if you're taking let's say you're taking 5 trades in a week, probably go 0.5% because you want to cap the damage. Do you see my point? You don't want to really, like, 5% down on your funded account. That's basically halfway down to like the death of the account. It's quite a lot. You don't want to really lose that much inside of one trading week. So this is what I mean. You have to have your average win rate, your risk to reward, like being around 2, and then your frequency of your trades that you find. Frequency as well can be manipulated, so you can find more trades or less trades. What I just said before, even bumping up the time frames or adding a confirmation will change the frequency. So focus on the frequency, cap the frequency, and you can maybe increase the risk. Something to consider, right? If you're someone that's good at the daily bias, I said this in the last video, and you're not good at finding the entry, if you work off just a 30-minute time frame and a 1 hour time frame from your entries, and you take 1 or 2 trades a week, day trades, but they're 1 or 2 trading days of the week at like a 1.5%, try it. You might even just see that it suits yourself better. You need to move away from this norm, right? What you're doing as you're becoming past the intermediate stage, you're moving away from the norm and you're finding a more like personalized, specialized system, right? Trade management, right? So following on from risk management, one thing that is underlooked is trade management. At every single point of your trade, you can reduce the risk or exit the trade. There's no one with a gun to your head to keep you in the trade, basically, right? If a trade is going your way, there should be a relevant shave in the stop loss. This is another process for you to make in terms of shaving stop losses. Remember I said building plans and processes and whatnot, right? What do you have to see in your trade for you to shave the stop loss? Like if you're bullish, if you make a new higher high, shave the stop loss. Big engulfing candle, shave the stop loss. Again, it's your confirmation for when to shave the stop loss or not, right? If your trade is a total of 2R and it goes 1.5R into profit and it goes to stop loss, you actually lost 2.5R, right? This is why trade management is so important. Because look, if you went up 1.5R, your stop loss is obviously at -1. It goes back -1.5 to break even, and then another -1. You lost 2.5R from that point in price. That's called dynamic. What do you call it? I think it was like dynamic risk to reward inside of a trade. That's from Tom Dante's YouTube channel. If you want to just YouTube that name, Tom Dante Trading, it would come up. If you become good at shaving stop losses, well, on average now you lose 0.5% of the initial stop loss and your take profit of 2R is met, your risk reward actually becomes closer to a 4 on average. On average, it becomes closer to a 4. Uh, on a sharp ratio basis, it will be closer to these numbers. On your risk to reward, there's a few things, but on a sharp basis, it'll probably be closer to like a 3 or 4. Uh, This is the power of trade management. If you can get break even most times, then even that's even better, right? Look, I'm just going to tell you guys something. In my mentorship, right, in my interbank, a lot of the times we don't really take a full stop loss, because we're not stingy with the stop loss. Number one, we put stop losses in good places. Um, and secondly, is as price is moving to like towards our take profit, we're just looking to shave risk off bit by bit by bit. 0.5%, 0.2%, break even. When you're break even, your fee is up. You're basically hoping that you got a good trade to TP or even pass the runner. Trade it into profit, even better. You're walking away with something. I don't like the idea of partials. The reason being is this, and look, there might be people that see this and they disagree. The reason is this: I found partials for myself. I don't like it. The reason being is this: it messes up the risk to reward. Right? You can partial like 50% of a trade, and then the rest goes to break even, and you then lose your next trade and you lose profit. Net is negative. If you actually just full cut the trade off, or you put you trailed stop loss to where you done 50% take off the trade at like 1 hour and you lose the next trade, you're break even. This is why I say it's better to trail the stop rather than take a partial, because you still have the full risk behind your trade, right? And if you're reducing the stop loss instead, towards your take profit, you still have the full force of all those lots, so all that risk towards your take profit. But you're shaving your stop loss, you're capping your loss to like 0.2, 0.3. Look, if you lose 0.2% trades, yeah, and, like, you're good. Your stop loss management is good in general. You're not using these ultra tight, stupid stop losses that people use. Your stop losses go at genuine levels of invalidation. For ICT guys, I say put them between 2 or 3 PDRAs maximum, right? Anything else is too wide. 2 to 3 PDRAs should your stop loss should cover, gives resistance to your stop loss. Um, as it goes towards your profit, shave risk off, like maybe it's at 1, consider maybe then 0.2, 0.5. Or if you got a good reaction, you can do it based off of price levels, and you see that where my entry was, or like I sniped it, price should have come back there, go break even, right? This is very good for longevity, right? So 10 0.3 percent losses is 3%. 10 1% losses is 10%, right? It's like a 3.333 recurring percent difference. Yeah, it makes a really large difference. Look, if you're on average losing 0.5%, now you're really good at shaving that stop loss. So you get most chances in your trade, you get to shaving the stop loss, and you're winning at a 2R. You're actually working more in the system of like, well, system plus ability of the trader. You're working in actually closer to a 3 to 4 hour system, because the way you're entering, the way your system is allowing you to enter and manage the trade, you're most times than not, on average, like 70 80% of the time, 70% 80% of the time, you're getting around 0.5% risk if you're hitting stop loss, and the upper end is 2R. Yeah, your system, the stats over a long period of time, if you show someone, they say, yeah, this is actually a 4R system. On paper, it will be a 4R system if you calculate the average loss and the stats, the average drawdowns and loss and whatnot, and the average take home, and you put it in, it will actually give you compute you probably a risk to reward of 4, right? That's the power of trade management. And also on the other end, if you see that your take profit was first, like your first level, but you see prices really running to it, look to increase it. Milk the trade for as much as you can. Like I said before, finding an extra 1.5R in a trade that you're currently in and you clearly have a runner, it it replaces the need of finding another trade setup, right? Because you've got another 1.5R in this trade. If your other trade setup, you're going to look for 2R. That extra 1.5R in this trade just made up for that other trade, right? Or even another mistrade. That winner, now it covers even more losses from before. Another stat to consider, this one is quite a big one actually, is and it links into trade management, is realized vs unrealized profit or gain, right? Essentially, this is the trader's efficiency in taking profit and managing to get the most profit out of the trades, right? This is very important for you future-based prop firm traders, as there's a trading drawdown element to your accounts. So unrealized profit is always higher than the realized profit, as no trader really ever has perfect take profiting. However, it's about reducing the gap and the distance between the two curves, and I'll show you on the next slide. It's not the most professional, but it works, right? So blue is unrealized, and let's say green is realized. We have two, left and the right. You see the distance between the one on the left and the one on the right? The one on the left, the distance is smaller. This person is better at taking profit. The one on the right, you see it's kind of flat in the unrealized gain. What this shows is this: the person gets a trade set up, is going the way, but they get stopped at break even. If you, and I don't know how many people can get access to this, right? I know brokers have this. Brokers, platforms, what they have this unrealized versus realized, but they have this stat. I don't know if like TradeZella or something has this. I don't know if this will ever reach anyone in TradeZella. If you have this, is great. If you don't, if you can implement this, something like this visually, great. Um, a way that you can manually do this, right? I tell my mentorship is so your trade, let's say it was 2R, and you just have to journal that you took 1R or 1.5R, and on average, just see the R difference between your your realized profit that you actually took from the trade versus what your take profit should have been, and what your take profit would have been, sorry, and yeah, then you'll see over time if there's a gap between your realized and your unrealized profit. Then what it shows is this, right? It's a form of immediate feedback. If I'm the guy on the right, I need to trail my stops more aggressively, right? I need to trail my stops more aggressively because I'm not taking any profit. My gap between the unrealized and the realized profit is too big, right? They're never going to be like line to line, but you want them to be, at least somewhat close, right? You want them to be somewhat close. If they're too far apart, then you have a problem taking profit. You're leaving too much money on the table. You want to consider perhaps better trade management. You want to consider when prices going your way, maybe be very aggressive with your stop loss shapes, because if prices coming back to you, take you out break even, just reverse engineer this idea, and if it happens to you more times than not, you just got to put in a hard stop loss shape. So let's say you're going up 1.5 or then it's reversing on you. Up 1.5 or hard stopper to 1. It's getting close to 2R and then it's reversing on you to break even, lock in 1.5R, right? These type of things, right? This is a form of immediate feedback. After you get the stats, whatnot, have a look. Am I leaving too much money on the table on the average? Like my trade, I was up 1.8 on this trade and then I got taken out for break even. That's a variance of 1.8 on the unrealized variance. That's a disaster probably. Um, yeah, that's something to consider. And if the worst case, I didn't even put this in because I didn't even think about it until now. If the blue line is going up, but you see the green line is actually going down, is negative, right? Is going down into the minuses. You need to at least minimum start putting some break even shaves um into your system, because the unrealized is in the green. You're actually making money on your trades, right? If you manage them better, but your management of the trade is so poor that as it's going your way, you're not taking no money off the table, you're not putting those stop loss shaves in, and you're actually ending up losing. That's a disaster. You want to fix that. So time frame variance in consideration. So if you have a hard time day trading, I recommend bumping up the time frames, right? Most people trade too low of time frames to capture the day's range and get caught in too many price swings. 1 minute has so many price swings, 5 minute even has a lot of price swings in the daily expansion. Um, you'll see there's a lot more clean swing points to work on a 30. Very easy, a lot less fair value gaps. If you get confused, there's so many fair value gaps on this time frame. Check the 30 minute and tell me if you have the same problem. Uh, have a comparison of the 3 minute chart versus a 30-minute chart in terms of how each builds a daily candle. So go from midnight to midnight, right? Let's say go to Tuesday to Wednesday, midnight to midnight on your 3 minute chart. Take a snapshot of it, right? So do it like this actually, it'll be about find a bullish day, right? Find one bullish day and then go on the 50-minute time frame, midnight to midnight for that day, right? So let's say it's Wednesday's candle. From Tuesday's midnight to Wednesday's midnight in your 3 minute time frame. Take a screenshot, and on a 30-minute time frame, take a screenshot the same day as well, midnight to midnight. Which one looked easier to trade? Which one looked very confusing and unpredictable on that time frame to trade? You want to take the one that's going to give you the least amount of work, right? The least amount of effort for the same result. That's what you want. If you're good at daily biases, reduce the variance. It's that simple. You're good at predicting the daily candles print. Of course, you can't, if you're day trading, you can't enter on the daily candle, even the 4 hour, because the risk and reward doesn't make sense. Where are you even going to enter, right? I'm saying the 30-minute is reducing as much variance as possible, and you're still going to get decent risk to rewards on that time frame. Really consider it. right? Now, the whole reason we have confirmations in the first place is due to being variances in the day's expansion and the low time frame charts. We don't need the same confirmations if you're on a higher time frame chart. For example, if you're bullish on a day and you're trading the 4 hour time frame, let's say, do you need any confirmation on the 4 hour chart? You just need to predict which 4 hour candle is going to be the bullish candle of the day, because 6 candles build a, the daily candle. You just need to pick one when the expansion of that 4 hour green candle for green day. You just need to trade that. It looks like this open of this next one's going to go higher. Boom, done. There's no confirmation. It's just entry, right? On the 1 to 5 minute though, you need confirmations, and too many confirmations sometimes it confuses people. You don't even get into enough trades. They lose too much. Uh, as they bump it up, try the 30 minute. It's great. I've introduced it to a lot of people, and they like it a lot, right? And remember, just because you see people trading very low time frames does not mean you have to. Social media, again, I've said in every single PowerPoint, it's a facade, right? So that's going to be the end of this 3 part. So the key points for this one is build streamlined trade plans and avoid clutter and overconfirmations. Practice them in simulation platforms, right? And focus on the stats provided. Look, I have zero affiliation with FX Replay. You know what they are? Look, it's as easy as it can get. There is so much content out there to learn. You have FX Replay. They let you trade in a simulated environment. They give you the stats. TradingView cherry picking and win this and that and this and that and this. Like I'll go long and short here. Okay, you get no stats. FX Replay, the stats they give you, amazing, amazing platform. I have no affiliation. I have no code. Don't ask me if I have a discount code. I have nothing. If I see a service that I like, I'll just praise them. That's how it is with me, right? I don't do these affiliations with the prop firms. If these prop firms and exchanges that always ask me for things like to team up watching this, I'm not interested as well, right? Um, Focus on building on performance and gaining a good self stats for a good sample of trades. I say 30 to 50, right? Look, don't do your first plan, right? Like practice of a plan and your stats are crap, and then cry and say my stats are crap. Look, the first time of anything is probably never good. Do it a few times, right? And then see your stats. Um, if you're solo, I mean, I don't know how to help you. You just really got to lock in your room and see just try and get better, right? Uh, if you have like a mentor to go for in guidance, they should be helping you, trying to bump the stats up, telling you what to go wrong, what not to. If they can't, take the red flag. Consider trade management to aid profit taking to close the gap between realized and unrealized profit. Very, very, very big, right? And consider time frame variance that suits your personality and trading style. Those are the main takeaways. And that's going to be it for the 3 part series. I might have one more video I need to see. But yeah, I hope it was helpful. Beginner, intermediate, and past the intermediate stages. The people that have learned the technicals and whatnot, even if you're profitable, this stuff is all useful to me. I take my own advice. I consider all these things, right? Um, it's so important. You need to get the stats, because once you got stats, you can then consider the risks, and the risk is everything. Because look, if you're someone that wins more on average, and your risk reward is good, and your frequency is in the middle, why not risk more on your trades? Why not? You're leaving money on the table. If you have a win rate of like, let's say 60, 70%, including even your bad times, and your risk to reward is at up 2 plus 1%, don't even think about it. I'd say go 1.52. Why not? You would make money at a faster rate. Yeah, you're gonna lose. If you lose 2, but you win 4 minimum. This is why practice and stats is everything. Because once you've got a good read on your performance, right? Once you've got a good read on your performance and the win rate, you're good at tracking your realized reads, unrealized profit. Consider the risk per trade at that point. Yeah, then you'll start to see differences. Trust me. Uh, I hope it was helpful. Uh, uh, you know, be my guest to share it around to these videos to people. Um, yeah, hope it was helpful. And if I ever do make another series, I'll probably see you guys in that one.